fundraising due diligence checklist for founders. I wanted to go through the due diligence part just because it's a part of the funding round that can really trip up a lot of startups. My name's Alicia Randall. I'm a fractional CFO and I'm also the founder of Fast Growth Consulting, where I've worked with dozens of startups preparing to fundraise, and due diligence is sometimes where cracks can start, particularly if we're brought in quite late into the fundraising process. So this video that I'm going to go through today, it's quite practical, taking founders essentially through what due diligence is and how you can prepare for it. I try and post a video once a month or twice a month if I have the time. So please do click subscribe. I talk about the finance function within a startup and scale up so that you can better manage your finances, particularly if you don't have a finance leader in-house. So what is a due diligence? It's effectively after a terms has been presented from an investor, they want to spend time doing their homework to check that you are a sound investment. It's a bit like if you buy a house and you get an offer approved, but it's subject to a survey, and you have a surveyor come in and go through everything in the house to make sure that it's sound. It's the same thing, but it's for your business. What they will look at are your financials, your legal structure, the contracts that you have in place, your cap table, HR setup, IP and operations. So even if you're early stage, it might be a bit more lighter touch, but they still want to check that you're on top of everything, particularly your financials. So they are backing you, not just your idea. So because they're giving money to you and your leadership team, they want to make sure that you are able to manage this properly. The most common mistake that I've seen is that founders and the leadership team wait too long. So they scramble to pull all these reports, documentations, financials together when the investor asks for it. So what I mean by that is at the beginning or during the due diligence process. This is where inconsistencies can come. It's also where founders have to say to investors, oh, we'll get back to you with that. And the result of this kind of approach is that investors start losing confidence in the organization, the professionalism, and it looks like the business doesn't have control over what they're doing. So even if the business is solid and you do have good controls, if you're not ready for the due diligence before you even start fundraising, then it can look like that you're a bit unprofessional. So if you think about it, 6 months out before you start fundraising, you really kind of want to start with the basics. So what do you need to do to get there? The first thing is you want to have clean bookkeeping. So you want to make sure that your bookkeepers are doing their job properly and the financials are sound. You have a clean balance sheet. You want to have 12 months worth of management accounts. Obviously, if your company is less than that, less than 12 months old, it'll just be up until the start date. So you want to be able to share 12 months worth of management accounts. You want a simple but working forecast. And in Europe, it's 3 to 5 years. I'd say in the US is probably only 3 years if you're looking at investors in the US. You want also an updated cap table. So you don't want a situation where you've done a small round and your cap table doesn't reflect that, or you have started giving your staff options and you don't have the option pool as part of your cap table. So make sure your cap table is updated. And then finally, you want clear revenue and cost assumptions. So what I mean by that is an investor will want to know how you're recognizing your revenue. And so you want to be able to clearly state, we recognize revenue at this point of the transaction because we don't owe the customer anything further. And you want a clear way of doing it and explaining it so the investor can see what you're doing. They may disagree with your revenue recognition policy, and that's fine. It may just be a timing thing, maybe something they want to change if they come on board. But as long as you're consistent and you do it the same way every single month. So if we think about the finance due diligence checklist, these are the things that you need to get ready and that the investors will check. So the first one, clean financials. And by that, I mean you want your 3 financial statements. So your P&L, your balance sheet, and your cash flow. You want to make sure that these 3 financial statements are the same as what they are in Xero or QuickBooks or whatever general ledger you're using. So it needs to be the same. You don't want to export it and then manipulate it, say in Excel. You don't want any mystery accounts. So other expenses, but miscellaneous expenses, for example, particularly if they're material. But you also don't want giant categories. So, for example, you have one account code in Xero and there's just so much going into there, and ideally you want to break it out. You also want one version of the truth. I would say that also for KPIs, but particularly your financials. The monthly management account, so you should have 12-month reports. Ideally, there should have variance analysis in that. So whether that's comparing it to prior month, prior year, or budgets, ideally budgets. But if you don't have a budget yet, because you're very early stage, you may want to compare it to prior year. And you want to show you're reviewing these results and managing against budget. Again, ideally you want a budget and have the variance analysis in there. I will leave a link above and below for what that looks like so that you can have a look at a good example of what your management accounts should look like. The revenue recognition, how do you recognize your revenue? Are you booking it on invoice or are you booking it on delivery? Is it GAAP compliant? GAAP compliant is your local accounting legislation that you're working towards. Every country has its own GAAP, or you might be using IFRS. If you don't know what you're using, speak to your tax accountant. They will be able to help you. But if you don't have an understanding of that, then this can be a really red flag, particularly for many SaaS and service-based businesses where delivery and revenue recognition isn't as clear cut as, say, a product-based business. And then forecasting. So your forecasting really should be linked to real drivers. So what are the things that drive the business? Using those KPIs or those drivers is how your forecast should be built. You also want to include in that what happens if you get new funds. So say you're asking for £1 million, it's early stage fundraise. What are you going to do with that £1 million? How are you going to spend it? So you don't just want to drag numbers across and just have a percentage uplift every single month. You actually want to show how you're going to grow the business. So for example, if you have a sales team and you're a B2B business, your sales team may, say, do 2 sales a month each. You want to talk about how if you grow your sales team, then obviously you're going to grow the sales, but also how can you make your sales team more efficient? What are you doing so that they could sell 3 products or services a month, as an example? So you want to kind of have a very clear way of demonstrating growth. With your cost base, you do want to, in the kind of forecasting piece and also your management accounts, you want a breakdown of spend. And ideally, you want to have a good understanding of who your key suppliers are. So who do you heavily rely on in order to deliver your cost of sales, say. You also want to understand your payroll, your headcount, your contractors. What approvals do you have in place? What is your P2P process? So purchase to payment process. You need to understand what is being spent on and why, and being able to demonstrate that is really important. And if you don't know that, it really shows when the investors start asking questions. And the cap table, you want that updated, you want it clear, you want to include all share classes, including options. And if there are any safe or convertible notes, that also needs to be included. Also any warrants. If you have any debt, you may have warrants associated with that. So you want it all to be clear so that any investors know exactly what the cap table looks like. So what should you not do in your due diligence? So what investors don't want to see is numbers changing every single week, particularly if you're not particularly organized. Forecasts that don't really match real data. They also don't want either a leadership team or your finance lead who can't answer questions. So if you only have a bookkeeper and it's yourself, ideally you want to be able to ask them questions. You also don't want founders avoiding questions about margins or runway. Founders do have to really understand their margins and their runway. And they also don't want documents arriving at the last minute. It really creates doubt in a due diligence and can kill momentum. My team and I have done due diligences, finance due diligences on the behalf of some small VC firms, and we have had real problems with the financial due diligence where we are asking questions for information and we're having to wait weeks. And in some instances, the deal has fallen over. In other instances, it's delayed the fundraise by 2 months. So if you're getting really close to having no cash in the bank, 2 months can be a really long time. So make sure that you're prepared. So how early do you want to start? What is the right time to prepare for a due diligence? I'd say 6 to 9 months before you raise. So the reason why I suggest that is it gives you time to clean up your bookkeeping, to build your monthly reporting rhythm if you don't have any, and fix any errors before they're under scrutiny, and stress test your forecast. If you leave it to the last minute, then this all becomes really painful and expensive. If you don't have a CFO, this is where fractional CFOs come in. We help founders build investor-ready reporting, create realistic forecasts, understand what the numbers are saying, support you in the investor conversations. Often one of us are brought in to meet the investor and ask loads of questions about the model. So we generally partner with businesses 6 to 12 months before the raise. We also have a 3-month founder financial foundations program where we can come in and just sort out your numbers in that 3-month time. So that's your fundraising due diligence checklist. Totally doable if you give yourself the time. So get those basics in orders, clean up your numbers, make sure your story and your spreadsheets actually match, and that you don't leave it for the last minute. If you're interested, book a discovery call, and if you want to help discuss where you need to prioritize. I also have lots of free resources that I'll link below. Otherwise, thanks for watching, and if this was helpful, don't forget to subscribe for straightforward advice for startup founders. Cheers.